Hello and welcome to the lecture for part 2 of chapter 5. So in this section I'll talk about notes receivable, again that more formal kind of receivable that we would have with people we lend money to or grant credit to. I'll talk about credit card sales very quickly, which is pretty straightforward, and then I'll spend a little bit more time talking about inventory flow assumptions. So in terms of note receivables, some terminology is worth talking about here. So first of all, a maker is the party that makes the promise to pay. So if you go into a car dealership and you sign a promissory note, technically you're the maker of that note, even though you don't make it yourself or bring it with you. They provide it, but you're making the note. The payee is the party to whom the note's payable. So in that case, the car dealership or the finance company is the payee. They're the ones that are going to get the money. The principal is the amount for which the note is made, so how much is being borrowed. And the issuance date, of course, is the date you sign the note when it becomes effective. And then the due date or maturity date is a date that it's going to be paid. The term is a length of time between the date it's issued and the due date. Now the notes that we're going to talk about in this class are fairly simple notes where you borrow the money and you pay the full amount of the principal plus the interest when it comes due. So we're not talking about the kind of note where there are monthly payments or those kinds of things. Then the interest rate is always expressed as an annual interest rate, and it's paid on the face amount or principal of the note. So when determining the due date of the note, you need to take into account that some months have 31 days and some months have 30 days, and of course one month has 28 days. So you need to calculate the number of days in each month to come up with when the note is due. So in this example, we signed the note on March 16th. It's a 90-day note, so it comes due on June 14th, not June 16th. So it's calendar days. An easy way to do this is in Excel. So you can enter a date in an Excel spreadsheet, just like you would enter a normal date. So 3/16/21 is an example for March 16th. And then Excel actually treats that as a number, and there are numbers, integers associated with each day on the calendar. So then you could do math on that. So you could do that in Excel plus 90 days, and it would give you an answer of June 14th. That's easier than counting on your fingers or those kinds of things. So the interest on the note is important. So the interest on the note, the formula for calculating that is the principal of the note times the interest rate times the term over 360 days or over 12 months. And we use 360 just to make the math a little bit easier. So as an example, if we have a $10,000 note and we have 6% interest, okay, so with 10,000 times 0.06, let me get my calculator out here so I don't make a mistake. So let's say we have a $10,000 note that is at 6% interest for 6 months. So I would take 10,000 times 0.06 times, and if it's 6 months, we can do 6 divided by 12. That'd be $300 interest on that particular note. And again, the maturity value is the principal plus the interest that's going to be paid. So that $10,000 6% 6-month note, the maturity value would be $10,000 plus $300 or $10,300. So that's pretty straightforward. The only thing that gets a little bit tricky is if that 6-month loan was issued on October 1st. In that case, at December 31st, we would want to record an accrual that we have an interest receivable. In that case, it would be $150. It would be for 3 months, $150 interest receivable and $150 of interest revenue. So we would accrue that for that 3 months so that we showed that on our financial statements at year end. The next thing I want to mention is credit card sales. So a lot of companies sell and accept payment via credit card, and credit card companies charge a fee. There are credit card processing companies, and they charge a fee for paying that. So if you go into a store and you buy a pair of jeans for $100 and you pay for it with your credit card, that store isn't going to collect $100. They're going to get something less than $100 because the credit card company will take their fee out before paying the retailer. So we want to recognize that when we make the sale. So in that first transaction there, in this case, we make a $1,000 sale, and it appears that the credit card company is charging a 5% fee, which most fees are in the 2 to 3% range. So 5% is a little bit high, but it makes the math easy here. So in that case, on our balance sheet, we would record a receivable of $950 because that's what we actually expect to receive. On the income statement, we would record a sale of $1,000 because that's what we charge the customer for that particular product. So we would recognize a sale of $1,000, and at the same time, we would recognize that credit card expense of $50. So we would recognize the reduction as an expense on our income statement. So then when we receive the payment from the credit card processor, and it could be a couple of days later, sometimes it's the end of the month they do it, different companies have different kinds of terms. So in that case, we would receive $950 in cash, and we would wipe out that $950 accounts receivable. The next thing I want to talk about is inventory cost flows. So when we sell physical product, we need to recognize the cost of that product. At the same time, we recognize the revenue that we earn from the customer. And if we buy items and we pay the same amount all the time, say I'm selling picnic tables and they cost me $600 and I sell them for $1,000. If that $600 never changes, then it's really pretty easy to figure out. You don't even need to worry about inventory cost flows. The problem is that usually we buy things at different cost over the course of the year. So maybe some of the picnic tables cost $580, some cost $600, some might even cost $620 if the cost of lumber goes up or something. So now I've got in my inventory, maybe I've got 10 different picnic tables, and some are at $580, some are at $600, some are at $620. So now we have to say, well, which one did we give the customer, and how do we figure out how to match that cost with that revenue that we recognize? So companies will assume a particular cost flow for accounting purposes. It doesn't have to match the physical cost flow or the physical flow of goods, but most companies do that. So there's 4 different cost flows that we could talk about. First, let me give you an example here, though. So here I've got 3 items in inventory. I bought one on the 10th, one on the 18th, and one on the 24th at 3 different costs you can see there. So depending upon which item I associate with the sale that I make, I sell the product for $20. If I assume it's the oldest one, then my cost of merchandise is $9 and the ending inventory is the $13 and the $14 one. Notice 9, the cost of merchandise, plus 27 equals 36. So I'm taking the total cost that I have there. I'm sitting on $36 worth of inventory, and I'm breaking that into how much I'm going to associate with what left in the customer's truck and how much I'm going to associate with what is remaining on my shelf. So if I assume that it's the May 10th item I sold, well, I'm going to get $9 for cost of goods sold, and I'll get a higher gross profit. If I assume that it was the one in the middle at $13, well, then I'll have $13 of cost of goods sold and $23 of ending inventory. If I assume it was the newest item, the $14 item, I'd have $14 for cost of merchandise sold and $22 for ending inventory. In all cases, those 2 numbers add up to $36, so it's a way to check your math. Let's talk about the different assumptions for how inventory could flow through a business, and there are 4 different assumptions. The first one is the best in terms of matching. It's specific identification. So I'm going to specifically identify which item I sold the customer so I can match that cost with that sale. That's the best method. Unfortunately, it's really difficult to do, except in cases of kind of high-end merchandise that each one is unique. So as most of you are aware, automobiles have vehicle identification numbers on them. So if I'm a car dealer, I can keep track of what I paid for a particular VIN number, and then when I sell that particular VIN number, I can recognize that cost, so I can match them up perfectly. So that's a good method, but you can imagine that would be difficult to do in a grocery store or even our picnic table example. The most popular method is first in, first out. And a good example of that is milk in a grocery store. So most of you are aware that in a grocery store, they load the milk from behind and rows of milk slide forward to the front of the case. And when people come in to buy their milk, they take one out of the front of the case. So each time a customer is taking a product, they're getting the oldest product first. They're getting the oldest product is what they're taking. So the first product that came into inventory is the first one that goes out of inventory. 90% of companies use this cost flow assumption. So chances are very good if you work in a retailer or a manufacturing company, they will be using FIFO. First in, first out is what FIFO stands for their flow assumption. And in most cases, for most companies, that also mimics the physical flow of the goods. So the reverse of that is LIFO. And I've got a picture of a big pile of beauty bark here because in that's the opposite now. So we're going to say that the last item that came in that was added to inventory is the first item that goes out for a customer. So I use this pile of beauty bark because they'll add to that beauty bark by however they make beauty bark. They'll add to the top of the pile, and if you show up with your pickup truck to buy a load of beauty bark, they'll take some off the top of the pile and give it to you. So you're getting the stuff that was most recently added, not the oldest bark that's at the bottom of that pile. So the last assumption is weighted average. So that's assuming that you add inventory, it all gets mixed together. So let's say you own a convenience store with gas pumps and the truck pulls up and puts $2 a gallon gas in your tanks, your holding tanks. They come a couple days later and put some $2.05 gas in your holding tanks. They come a couple days later and put some $2.10 gas in your holding tank. And then somebody shows up to fill up the gas tank in their pickup truck a couple days after that. Well, which gas are they getting, right? So that gas is all mixed together. So they're getting an average of all of those things. Personally, this is my favorite method because it's most easy to explain to non-accountants. So I kind of like this method. So let's walk through some examples here of the three prominent methods, so excluding specific identification. So in this case here, and in all three cases, we are running a bicycle store. So we have beginning inventory, 10 units at $200. On March 18th, rather, we make our first purchase. We buy 20 bikes at $220 each. And then on August 21st, we make a second purchase, 25 bikes at $250. So I've got 55 bikes that cost me $12,650, okay? In this simple example, we make one big sale of bikes on September 1st. We sell 43 of those 55 for $350. So if I'm using first in, first out, I'm going to assume that I'm giving customers the oldest bikes first. I'm going to start with the beginning inventory. So I'm going to give them the 10 of those at $200. Then I'm going to give them all of the first purchase, those 20 bikes at $220. And that isn't enough. I've given them 30 bikes now and I need to give them 13 more. So I'm going to dip into the more recent purchase and give them 13 of those bikes. That'll add up to 43. So when I multiply those three layers of inventory I'm giving them, the cost is $9,650. So that's what I would recognize as the cost of that sale. That leaves me with 12 of the $250 bikes on my shelf. So I'll have $3,000 of ending inventory. You can see I add those two numbers together, I get $12,650, so I know I haven't made a mistake. The next method is the opposite of that. Same exact scenario in terms of beginning inventory and purchases. I make that one sale on September 1st, but now my assumption is that I'm going to give customers the newest bikes first. Okay, maybe that's how I've got them stored in the warehouse or something. So I'm going to give them all of that second purchase. The $250 bikes, I give them all 25 of those. That's not enough to satisfy the order for 43. So I have to dip into that first purchase and give them 18 of those bikes. So here I've got cost of merchandise sold of $10,210, and the remaining inventory is 2 of those bikes left from the first purchase, and then all of my beginning inventory. So I maintain that old inventory there. And again, those numbers add up to $12,650. In cases of inflation where costs are going up, this method here, LIFO, is always going to give me a higher cost of goods sold. So the reason is my assumption is that I'm giving customers the newest items, and in inflation, those are more expensive items. So why would a company choose this? Higher cost of goods sold means lower gross profit and lower net income. So why would I want lower net income? Well, reducing tax expense is the #1 reason. So if you're the sole owner of a business and you're not worried about impressing anybody, a bank or anything with your net income, then a tax avoidance or tax reduction strategy can make sense, and this method might be helpful. The last method is I buy these same bikes. I've got $12,650, but I take an average of all of that. So I say my average cost is $12,650 divided by 55 bikes. So on average, those bikes cost me $230. So how do I cost 43 of them? I multiply it by that average cost of $230. So I have a cost of goods sold or cost of merchandise sold of $9,890. This is always going to give me a number in between FIFO and LIFO. My ending inventory is 12 bikes at $230 for $2760. Again, I can check those numbers add up to $12,650, so I can tell I haven't made any math mistakes. So we'll work on some of these FIFO examples together in class. I hope you found that lecture useful. Thank you very much. I will talk to you in the lecture for the next chapter. Bye-bye.